We're thrilled to have you, Nick. Thank you so much for joining us. As a quick introduction, Nick Mccoy is a co-founder and managing director with Whipstitch Capital, the largest independent investment bank in the United States, solely focused on the better for you consumer sector. Nick has over 20 years of investment banking experience and has worked with Whipstitch co-founder Mike Bergmeyer since 2008 at a previous investment bank that Nick also co-founded. Nick was in the investment banking group at First Albany, which is now Jefferies. He was the director of M&A at All America Financial Group or Financial Corp, and a senior director of corporate development at Wheelabrator Technologies. Wheelabrator, yes. I got it. So Nick often speaks and has done so for Branchfood on so many occasions. And is quoted on various investiture and acquisition-related topics. He's a chartered financial analyst and has an MBA from Wake Forest University and an undergraduate degree from the University of New Hampshire. Personally, Nick is an avid road cyclist and thinks it's okay to cross-country ski in below 0 temperatures. We were just talking about his ability to do so up there, where he is in New England today. And he's a health-focused foodie, cooks frequently, and has an extensive knowledge of wine and whiskey. Just ask him. So thank you for joining, Nick. We're thrilled to have you here. As always, really appreciate your presentations for Branchfood and the community and all of the work that you do with entrepreneurs on a daily basis. So I'll turn it over to you to get started. And thanks again.
Thanks so much, Lauren. And I hope we do get lots of questions afterward, not necessarily on wine, but I'd love to get questions afterwards. So please do. Real quick, Whipstitch Capital is the largest investment bank in healthy living, as Lauren said. What we really do is we work with clients in better for you food and beverage companies, called innovative better for you. We do some in personal care, a little bit in supplements. It's kind of hard where you draw the lines on the better for you movement. And what we really do is help companies develop their growth plans so that they can get funded. And there's a lot of detail behind that, validating off of data, trying to figure out which companies are going to, be ready for growth capital based on that data and their performance, as well as, we help companies when they want to sell to a larger strategic or to a private equity firm doing a roll-up. And again, it's a lot of the same exercise, figuring out what are the validating data points and what are they doing well, and, where are the opportunities for the new partner to continue that momentum in the brand. There's a few tombstones down below, Core, Kavita, Flying Embers, brands that we've done over, probably 80 transactions, 90 transactions since 2010 or so. But into the material here. So obviously, things right now are very different than they were a month or two ago, and that's manifesting itself in a lot of ways. Right now, just focusing solely on financing, deals are still getting done. Companies do still need money and are getting it. There's a lot of funds with committed capital that need to deploy it. That being said, today is not a great time to start a process for a very large fundraising where you're going to be bringing in new investors as a lead. So, if you're going to go out and raise $10 million and that's going to, that would have taken you 3 or 4 years, hopefully to exit, and that was reliant on, a brand new investor, this is probably not the best time to do that. It's better for you to think about raising something for 12 to 18 months and, kind of bridge over this period of time here and do that afterward. Obviously there's exceptions, and depending on the, the need and the opportunity, but just as a guideline, that's I think kind of what we've been telling people. Right now, in getting through that 12 to 18 months, your best investors are your current investors. Talk to them, be realistic. I'll get into more of that in a minute. As far as getting money quickly and efficiently, convertible notes are a friend right now. They're easier to paper. If you can do a SAFE, that's even quicker. Convertible notes are maybe 20 or 30 pages of legal docs. A SAFE is anywhere from 4 to 10. Provide market terms, a cap, a discount. Try to allow for at least a 12-month runway. You really don't want your convertible note to mature if it takes a little bit longer for good or other reasons for you to go raise a larger round. If you can get CARES money, and there's kind of lots of information out there on that, it's very complicated, but if you can get money under that, that's very, very good. I would very much encourage everybody to do that. And figure out tools to measure your ROI on spend today, showing capital efficiency. And if you're raising whatever $1 million to get through 12 or 18 months, what are you going to be able to do with that? And have real milestones. Some of the challenges and the reasons why it's tough to raise a larger round right now is investors are a little bit in the dark on valuations, yet at the same time, the fundamentals seem stronger than ever for most branded CPG companies. And the latest spins data quad just came out a couple days ago. We haven't fully digested it, but I just happened to be looking at bars earlier, so I'll make the example. Bars as a category is up 25% in this latest 4 weeks compared to the 8 weeks before that in MULO, which is basically conventional grocery. That's a unheard of rise. I mean, you just wouldn't see a category like wellness bars do that. And we're hearing anecdotally, and we have heard over the last few weeks from lots of companies that their supply chains are challenged, the co-packers are challenged to keep up demand for orders. So the fundamentals are great, and people are very focused on vitality and wellness, which is great for the sector. Liquidity risk, investors are thinking about, okay, how long is this capital going to last? If you're raising that money for 12 to 18 months, it's really important that you raise enough and you can convince investors that you're going to get through, the crisis, for lack of a better word for it. So being specific with cash needed and knowing your runway is really important. There's a lot of data noise right now, and some of that works in our favor, and some of it just makes it very difficult to judge performance. The data noise is because there is a big surge in orders, and that's affecting different companies differently depending on the channel they're in, the category they're in, and it becomes more difficult to compare your kind of units per store, per SKU, per week now to last year because you have this uptick. The solution is you really need to look at data from all sources and benchmark versus things that are tangible. Like your competition is also up. The category is up. You can benchmark against that. You can look week to week at Whole Foods data, for instance, through the portal, and you can see how you've done through the weeks and how that trend has gone through the stockpile period. There are some disruptions in companies like supply chain. Some people are having a hard time meeting demand through co-packers and things. This is very company and category specific. We're going to talk more about this in a little bit, but prioritizing your lead SKUs, manufacturing the things that move the most velocity is what's important right now, and monitoring your out of stocks, of course. And then the last thing that's a little bit of a challenge here is maturing debt. And this goes to the point I made earlier. If you're going to do a convertible note, or if you have a convertible note outstanding, it makes a lot of sense to get ahead of a maturity date and talk with your investors now and try to extend it out so that it's 12 or 18 months, from today. Even if you have to give a little bit to do it, you really don't want those notes to mature, in the middle of this crisis, if we want to call it that. So with that, that's one of the reasons why you're seeing some diverging approaches here from strategics, institutional equity, and family offices. Generally speaking, high net worth individuals and family offices as investors are the first capital to dry up. And that's because their focus is the broadest. They're not just looking at funding, CPG companies. They're looking at estate issues. They're looking at tax issues. They've probably got real estate investments. They may have other businesses that they own. So their scope of focus is so much broader that this is one of 10 or 12 things they do. And some of those things might be more urgent needs and distracting. For institutions, deals are continuing, but the pace is slower. Just to the point earlier of there's a little bit of uncertainty around valuations. There are distracting portfolio company issues if people have food service exposure in their companies, or if they have restaurants in the portfolio. They're obviously prioritizing dry powder for those needs. There are varying activity levels too. People who have new funds, some of them are out there and being very aggressive, saying, hey, we haven't deployed any capital. We really want to do it. We're open for business. Nothing has changed. We want to move forward, and you're seeing those people putting term sheets in aggressively. And some have kind of switched to, hey, we've got a small amount of capital available. We want to find a bargain with what's left. As far as strategics, they're still very interested, but the distractions are somewhat greater there, particularly with international, particularly European. Again, international, multinational companies have supply chains that span over multiple countries, and everybody knows that makes during a disruption like this, that makes it even more distracting. And then there's just imminent issues, like if If you're a supplier of a product which might get prioritized for hospitals instead of your target order, dealing with that, or 5 to 10x orders on that. The issues are kind of all over the map, but they're still very much at the table and in business, and there are deals getting closed, as you've seen. In talking to investors, some good strategies. First of all, be honest and transparent. Your investors, every investor expects bad news right now. So get it all out early, build the trust, build the credibility. It's much better off doing that than having to have, death by 1,000 cuts, where you continue to, dribble out little bits of news over the next, few days, weeks, whatever. Focus on what's working. Everybody knows what's unknown. Focus on what you can know and what you're doing to address the uncertainty. Be numbers-based with everything. Again, look at your gross margin in detail. Compare your sell-through data to things that you can compare it to. And investors are risk and return. Right now, they're swinging a little bit toward, what's the risk rather than what's the return. So anything you can do to mitigate their perception of that risk, and that is, knowing your forecast plan in detail, know what your cash burn is. If you can, you should very quickly be able to answer the question of, over the next 3 months, if I get, X amount in orders, how much cash am I going to burn based on things that are expected right now? Or what is my daily core burn rate? That's, all of your salaries, your rent, utilities, things like that. If you have quick answers to that, it builds a lot of credibility. Use the opportunity to impress and stand out. There's going to be some one-time jumps. There's going to be some misses. And again, benchmarking is important if you can do it. I've talked a bit in the past, and right now, I think it's worth bringing up because it tees up a few things. That when you look at the kind of M&A market, look at the kind of total, better for you branded product market, you have brands that are up to about 100 million, and I call those kind of the founder-operated brands. And then you have brands that are 300 million or more, which fit very well into large strategics. Large strategics are very, very good at marketing huge brands, and they've kind of stretched the model down to something in the 200-300 million range. But below that, it becomes difficult to get the attention from brand managers, and honestly, to make them as profitable in their brand management model as the larger brands. What's in the middle, I call the gap, and what we're seeing is as the number of smaller BFY brands grow into that gap size, because the market is growing, and we are, depending on your measure, anywhere from 10 to 30% of all food at this point, more and more companies are in that revenue range. And what we're seeing is that founder brands are adopting new strategies to be able to manage the complexities of being a bigger brand, and it does get exponentially hard. It seems to be, at least. Strategics are dipping down into there through venture groups and things like that to be able to acquire earlier. And private equity is really the biggest force. They're moving in, doing lots of later stage checks and lots of acquisitions. To give you an idea on how much, the chart here on the left shows the last 10 years of capital raised from private equity over time in consumer. So it's actually a very large amount. There's some examples of deals on the right. So you can see that whenever you have a market opportunity that exists, as we do with companies that are in that revenue range that aren't getting bought by strategics until they're a little bit larger, people move in. And that's exactly what we're seeing with private equity, existing funds and new funds that have been looking at the sector for a long time and haven't gotten in because they've had EBITDA constraints or other things. There are two basic kind of growth strategies for companies, for better for you companies. One is the traditional managing for growth strategy, which I think we've seen a lot over the last few years. That is, grow very quickly, raise as much money as you need to do that. The more you grow, the valuations will rise. You'll take a lot of dilution, but you'll get a big revenue-based exit eventually from a big strategic. And the objective there is narrowly focus. If you can get your brand in additional categories, great, but they should be very close together in the store so you don't limit your buyer base. And it's really focusing on more SKUs in those categories, more velocity in those SKUs, and more channels, and getting that product out there. The whole goal being a $100 million plus brand with a lot of headroom when you sell, so that a big strategic can make it larger, getting into the range that they're comfortable with. The manage for profitability strategy is, if you have a brand that's a niche brand and it's going to do very well as a $30 or $40 million brand, but it's not necessarily going to be $100 million plus brand unless you really take down price to an uncomfortable level, or try to push it through a trade spend. You can hold your price point, you can hold your margin, and you can become profitable much more quickly, taking a lot less capital. And we're seeing more and more brands do this. First of all, just because as the industry expands and the number of kind of available white spaces grow, there are a lot of niches that are available now. Things that might only get to 10 or 20 ACV in mainstream, may dominate natural, might do really well online, have a little bit of food service, and you can get a brand with 30 or 40 million in revenue with 6 or 8 million of EBITDA and get a very reliable exit right now to private equity. If you have a $10 million EBITDA brand, you're almost guaranteed to be able to exit that brand today. Obviously if all things being equal in the business plan, almost guaranteed to exit for something at least 8 times revenue or at least 8 times EBITDA or higher. So the managing for profitability strategy, particularly in times like this, when you're looking at conserving dollars, makes a lot of sense. It really reduces risk going forward. Taking one more step back and thinking about execution during COVID, I've kind of collected a bunch of notes from other presentations, and I've put some of these on the screen here for everybody. One thing is, right now everybody is getting a surge in demand. Eliminating your trade spend to the extent you can in the near future preserves more margin, and that's the best money you can raise because it doesn't cost you any equity and it reduces what you're going to have to raise in the future. The more gross profit you have, the less you have to raise. So again, that's your cheapest capital. And right now is a great time to do it because anybody that's buying is buying because they want to buy your brand. And that might be because you might be one of the last few on the shelf, and that's great. You get new people trying it. Delaying new innovation. There's no reason to try to make a reset right now because resets are being postponed and resets are being limited. Resets meaning times when you can slot into a new spot in a major grocery store. I even heard yesterday that there are some grocery stores that are seeing big runs in certain subcategories, and the buyers are actually expanding those categories real time to cut SKUs in adjacencies to create like freezer door space, for instance, which I hadn't seen firsthand, but I've now heard it from 2 people. So that's interesting and consistent with what I've seen in postponements. Analyze your cash flow on a daily or weekly basis if you need, but staying on top of your cash runway right now builds a lot of credibility with your investors, and it's really crucial to running your business. Negotiating better terms from your distributors and suppliers. Everybody's going to benefit in the long term. They're going to benefit if you make it through this and they make it through this. So we're all kind of in it together, and people are more receptive to renegotiation now than ever before. Again, prioritize your high velocity, high margin items. Adjusting your production and logistics to the extent you can. Again, prioritizing the high margin items there. And to the extent you can do it, refining your market budget and messaging to favor those very fast moving SKUs. To do things that are going to give you near-term return on online, for instance. Trade spend is something, is a very, very big part of our business. And I don't know what the average is, but it's somewhere in the high teens, if not 20%. And then when you look at numbers, it's an astronomical number. But when you actually look at what you get out of it, we did a study and we looked at the top 20 brands and spins, and then we looked at 20 brands and spins that span from 3 million to 22 million in MULO sales, objectively, kind of one for each million. What we did is we looked at the last 24 months for each brand, what was the change in price and what was the change in sales. And as you can see, the better for you brands had a very, very small change in sales compared to the conventional. Conventional brands, the largest 20, actually had a 4.5 times the impact from changing price. So this data would suggest that if you are in a normal environment, you're better off being on sale than how much you're on sale, because being on sale means you've got a sale flag there to get attention, but people are going to react more to that than the actual depth of the discount. So this is an empowering thing right now. When you're thinking about cutting your trade spend, it's a very empowering statistic, to keep in the back of your head that, that deep discount that you might have been offering isn't actually going to get you that much more sales. And here are the numbers on trade spend. If you look at the industry in total, 250 billion right now for natural products. That's about 125 million or so in company revenue. At 20%, it's $25 billion. That's a lot of money. that can go into marketing, sustainability, other things that can build a brand in the long term and reduce capital needs. So, the COVID crisis is affecting everybody very personally, beyond professionally. And, I think there are times that, the media can get everybody down, and, it's impossible not to be sensitive to it. But I do think that there are some silver linings that can come out of this, and focusing on those, is a great way to sometimes draw strength when, things are difficult on a daily basis. And, as this gets larger, it's hitting closer to home for all of us. And that's very, very, very difficult. I know, I hear stories every day, and it's horrible. But some of the silver linings is, our population right now is increasingly focused on wellness. And if, immunity purchases right now are astronomical. And if you look at it, right now we've got 7.8 billion people on the earth. We're going to be at 10 in 2056. And, just having, that much more close distance between people as the population expands increases the chance of other bugs. So your wellness is your defense. And I think people are recognizing that, and healthier food and beverage habits are going to come out of this. And we're definitely seeing some of that in purchases today already. But I think there's a secular component of that will last through this surge. There's probably going to be a move away from individualism, new investments in public goods, public policy for health, public services, that will be very positive for our sector. Online won't just be a channel for where you can sell. We're seeing people do Zoom, Zoom and other online meetings in very different ways. It could even be something you can use more in marketing, more directly in the future. I think there's all kinds of community that we're going to get out of this in the future with creativity, based on what we've had to do today, and how we're creating new patterns and adaptations of presenting and talking to people just like this. Domestic self-sufficiency, we've already heard with policymakers, the idea that we want to have domestic production in all sectors. I think, the ability to reduce the need for imports and the efficiencies, plus the green, the global benefit of reducing, all moving products around the globe in ships to an extent is very positive. Land conservation, our country has 12% of the arable land in the world, and we're projected to have about 4% of the population. That means that we're going to be a big exporter one day. We already are. It's actually the only positive part of our trade deficit right now. Is the only positive is in exports of agriculture. So land conservation, making sure small farms make it, and policy that does that is going to be, and not spreading disease. That's all very positive. If you look at the 1918 flu, if you look at World War II, there was a post-crisis boom. That could very much happen here. People are seeking relief from stress, pleasure, search for community. Radio and cars were largely launched out of the 1918 flu post-boom, and of course the Roaring '20s. And then an increase in community, and we're already seeing this. People reaching out, helping people at all levels, whether they're your neighbors, whether they're business colleagues. I'm seeing it from all angles, and I think we as a society has been running around and flying everywhere. I do think that we're going to see a lasting increase in community, which can be very helpful, as nobody knows everything, and it's really challenging and really complex to build brands. So the more you can benefit from others, the better. And that's what I have, because I'm not going to read the disclaimer to everybody here and take up the next 5 minutes doing so. Do we have any questions?
Thank you, Nick. That was great. So we'll turn it over to questions. If you have a question, you're welcome to submit it through the chat. It will come directly to me and I can ask, or if you'd like to unmute yourself and ask a question, it's been fine to allow folks in the past to do so. So I'm anticipating it's something that we can do on this call as well. So if you have a question, please unmute yourself, and you're welcome to ask at this time. Nick, one of the questions that we actually had through the chat was for small brands and brands that may not even be on shelf yet, what should they be doing during this time? How can they best prepare for, the hopefully normal, a return to normalcy, if you will, for the industry in terms of resets and actually getting on shelf? What should they be doing, and how can they be optimizing this time right now?
It's a great question. And I think actually small brands, when you look at kind of who's vulnerable to a capital crunch, small brands have, things that apparently that, aren't on shelf yet, actually have the most flexibility in their choice of timing and in cash conservation or cash usage, because you're not already stuck, on shelf with a co-packer that demands a certain amount per month and retailers that are, begging you to do discounts, and, just a burn that happens when you're in that, whatever, 1 to 5 million revenue range. So right now is a really good time to get as much information as you can around what is going to make your brand work. If you can sell online, sell online. See what you get for comments. Engage your customer community, and try to figure out what's going to work to sell the brand. Is it do you need to redo your packaging? Do you need to redo your size before you actually go on shelf? The earlier you make those adaptations, the cheaper they are to make. Every product that gets out there and has a big headline sale at the end of the day, they're probably on version 5 at least of their packaging, and sometimes even their formula.
Oh, great. Another question that came in is, when do you expect resets to resume? Are you hearing from retailers, both, I would include independent small retailers, but also kind of larger, some big box stores. What are you hearing back from them, if anything at all, at this point?
It's a great question, and this is a very moving target. I don't think resets have stopped. Anecdotally, I would say that probably they're going about 50% based on what I've heard in larger stores. And I really don't know on kind of the smaller natural channel stores. I mean, they obviously have more flexibility, some at the store level, even within chains. So I do not think this is a long-term phenomenon. If you're a buyer, your revenue per linear inch is really what you're graded on. And you need innovation to maximize that. Better for you products may only turn 1 or 2 a week compared to 3 or 4 for a conventional alternative, but they have a higher price point many times, or they might even take up a little bit less space. So you can it's very important that they bring in that innovation and trade out other brands so that they can keep maximizing revenue. I think there's just a lot of logistical issues right now that are getting in the way, like keeping the shelf stocked.
Great. And another question that is somewhat more so related to your work on the regenerative agriculture side. Do you see that being a big focus sooner rather than later rather than sooner, and the designation around that to be an important attribute of new brands that are coming to market?
I think it's a great question, and nobody has a crystal ball, but I do think that if and one of the reasons why we did this trade spend analysis, this price elasticity analysis, is to figure out if companies did reduce their trade spend and they repurposed that money in things like more sustainability in the supply chain, in brand building, what is their impact on sales? And I was really pleased that it was it appears to be as low as it is. But if you look at the amount of land we have, and if you look at the the fact that no matter which side of the aisle you sit on, the politicians like a trade surplus. Politicians like a growing economy. And right now, if agriculture is the only positive number in a $750 billion trade deficit, I just have to think that at some point in time, all that comes together. And if we can align economic policy and environmental policy, then you mitigate some political inertia. If brands can bake into their ethos earlier on a sustainable supply chain, customers more and more are valuing that, particularly younger customers that are getting older and having more buying power. So it's very difficult for a brand that's been around 100 years to suddenly flip and say, hey, we're very authentically non-GMO, organic, regenerative ag. And by the way, most of them can't even do it because they have to buy so much of certain ingredients that they probably can't get them reliably in the quantities they need today. But for smaller brands, you have that flexibility. And if you build it into your brand ethos earlier, that's a very good long-term investment.
Mm-hmm. Mm-hmm. Great. Well, I know we're coming to 1:30. We did have more questions, but perhaps we'd encourage people to tweet you or connect with you directly to get them answered. Want to thank you for your time, Nick. That was an excellent presentation and such interesting insight, particularly on the note about sales and for brands that are on shelf, lucky enough to be on shelf at this point. Any type of discount, any type of sale reduction is a major driver to customer purchasing. So thank you very much. Thank you all for joining and tuning in. We will be back again on Monday with Isabel Kelly Smith, founder of Isabel Kelly Smith Nutrition, speaking about self-care and eating healthy in the time of COVID. So please join us as you're getting your week started off on a healthy foot. And as a quick reminder, all upcoming and past sessions can be found on branchfood.com/servingupsupport. We will and have been updating our YouTube channel with presentations. Next presentation will be on there as well shortly for any of you that would like to share this or listen to it again and see this deck. It's great content. So thank you all for tuning in. For any feedback, you can reach us at info@branchfood.com. And we look forward to seeing you all on Monday. Have a great weekend. Thanks again, Nick.
Thank you, Lauren. Thanks so much.
Okay, bye-bye.
Bye.